Well, welcome to the conversation wisdom of wealthies or wealthers or whatever we're calling ourselves. Ryan Haley and I are here in the studio today, and we are going to pick up right where we left off last time with the IBC conversation and go straight into an example, a real life kind of practical of how you can actually take the financing that you're running through infinite banking and use it in your personal life. So, Ryan, would you take it away?
Yeah, excited to follow up. This is kind of where the rubber starts to meet the road here. So, following up on last time where we just showed a hypothetical illustration of the policy itself, we're going to now take the next step. And this is actually a real life client of mine. This is not a hypothetical. And I'm going to show you guys how we used this infinite banking concept using the cash value of a life insurance policy to fund, in this case, a real estate investment syndication. And so, just a couple baseline points to get started. This is a client who is age 47 at the time of the policy issue. He's a standard health rating, so it's not the best, it's not the worst. It's I would say this is actually a fairly conservative illustration, since a lot of times people get a better health rating, which makes a difference. But I think it's good just to show a more moderate expectation. And so in this case, we are starting off here, and we'll say again, like last time, this is really meant to be viewed on your screen, ideally a full computer screen at home so you can follow the numbers. And if you're listening to this on audio, again, it'll help, but we'll put a link in the show notes so that you can go to the YouTube video just like last time. So with that said, in this case, same thing as last time, we talked about how there's an optimal ratio between what's called the base premium and the paid up additions. And so in this case, this client is a high net worth accredited investor with really strong income and cash flow and liquidity. And he has been doing extremely well investing in private placements for real estate syndications, in this case, a commercial multifamily property. So he's already doing really well with that. And this is something we've talked about before, but a lot of times when we talk to people about this concept, they say, okay, that's pretty cool, but why would I settle for 3, 4, or 5% in the policy when I can get, 18, 20, 30% in real estate or other investments? And again, as always, the answer is you wouldn't. If you're getting those kinds of returns, keep doing what you're doing. Don't want to mess that up for you because you're obviously doing really well. But let me show you what this would look like if you just do the exact same thing, except instead of funding those deals directly out of your personal checking account, you run it through a policy first, then borrow against the cash value to put in those deals. So you've got that money working in two places at the same time. And so if you're not familiar with any of this, if you're coming in just cold here off the street, so to speak, then again, go back and listen to the other episodes because we go into a lot of detail. This is a multi-part series that builds on the last one. So we're going to assume you're already familiar with that. But this illustration, he was putting in $300,000 a year for the first 5 years. And again, if these numbers seem overwhelming to you, you can move the decimal place or the zero, add a zero, take off a zero. They generally scale proportionately. But this is, again, this is an actual real life situation. So I just wanted to show you guys something that was not hypothetical. So in his case, again, he's got very strong cash flow. We wouldn't do this if this was all his income. This is about half or maybe even a third of their total annual income. So you don't want to be overextended. But in this case, he's going to put in $300,000 a year for the first 5 years. Then he's going to drop it down to a $65,000 base premium for the next 5 years. And you can see here on the screen that he's going to be behind a little bit for the first several years. And then eventually the cash value buildup starts to overcome the cost of the insurance and the total premium outlay. So once he's done after 10 years in this example, he's not going to put anything in again. And so this is pretty much what we talked about last time, just with some different numbers. Now, the part that I really want to bring your attention to is the actual investment profile of what he's going to be doing. And again, we did a lot of episodes with syndications and how those things work. So check those episodes out if you're not familiar. But the investment profile, this is what he was already doing. So I'm now switching to my screen, showing you what the expected return profile of this particular investment that he's doing is going to be. So he's putting in $200,000 a year, and he's getting an 8% preferred return which in this case would equate to $16,000 a year just on the property level cash flow. What's cool about these models is that in year 3, and of course this is all, a hypothetical pro forma, but they tend to be, this is a pretty representative return profile. In year 3, assuming that the sponsor operator or general partner has done a good job, they have driven forced appreciation to generate equity in the property. So they can usually do a cash out refinance loan in about year 3 to get all of the investors' money back to them, their entire investment outlay, tax free, because again, a loan, just like with a policy or anything else, a loan is not considered taxable income. So in year 3, he's still getting that 8% preferred return of $16,000. And he's also getting his entire $200,000 initial investment outlay back tax free. So he's already ahead of the game by year 3 here. Now he's kind of got basically an infinite return just in the real estate investment because he's got all his money back. He's still collecting that 8% preferred return of $16,000. And then the 5th year, it's expected that they would sell the property and that it would probably have, about a 15% long-term capital gain. And so that would be, again, just based on the illustrations and the pro forma return profiles my client gave me, this is how I modeled it. And this comes back to something Kyle and I keep talking about, which is that it's not only super important to know how to structure the policies themselves, but it's also really important to structure that in a much bigger picture context of the overall financial situation of that client and the other factors involved. So we matched up the investment profile with the policy design. And what I wanted to show him was, here's what you're doing. You're doing really well. Over 5 years, you're getting a net IRR of about 20%, which is phenomenal, right? Most people can't get anywhere close to that in the stock market. And it could be more, could be less. He actually had one of these deals that went full cycle in like a year and a half or 2 years. It was actually a 25% IRR. So this is actually, I think, conservative, although obviously with markets the way they are, these things can fluctuate. But the point is we have to make reasonable planning decisions on the front end and then be able to adapt and be flexible. So in this case, doing really well. He was going to put in $200,000 a year at the outset of this plan. He was going to do that for 10 years, and then he was going to retire based on the returns from the investment and then the policy, because at that point, again, he's no longer paying any premiums after year 10. So before I move on to the next stage, Kyle, do you have any questions or comments?
Not yet. This is really good. And I think it is helpful to just remember as we go through this that the infinite banking policy is not replacing investment strategies. It is more operating like a bank. And so we're not looking at these net IRRs inside of the policy and comparing it to his investment strategy, which is exactly what Ryan's saying and why I believe that this illustration is so extremely helpful for understanding how infinite banking actually fits into the picture. So this is great.
Yeah, absolutely. And so, again, the idea was, hey, this is what you're doing already. It looks really good. You're not changing anything other than just redirecting the flow of your money. So instead of just funding the deal straight out of your checking account of $200,000 a year, getting a phenomenal return, what if we put that money into a policy first and then borrowed from the policy? Now, there are a couple examples or details in here that aren't put in, like the fact that he's going to be paying interest on the policy loan. But what's also kind of offsetting that is that his returns inside the policy itself are tax-free because it's set up as a non-MEC, and it's also not showing the benefit of the interest deduction that he's going to get to offset this income. So again, without getting too in the weeds, this is a fairly high level. It's not going into all the details, which we're going to go over in our next episode with one of our guests who's going to show a cool business application. But again, just broad level, this is what it looks like. So then I showed him, okay, what is the difference between if you're doing this just status quo, the way you're already doing it, versus what would it look like if we did the same thing running it through a policy? So that is where this comparison comes in. So what we did here, and there's a lot more to this than just what I'm showing, but I'm not going to go into all the details. This takes a lot of planning. We took his, household, family, free cash flow, liquidity. There's a lot of other things going in here, which it's beyond the scope of this particular episode to go into all those details. And maybe we can do that at some point. the main point being here, there is a significant amount of planning and financial modeling and stress testing that needs to go into this to do it right. We don't want to just take pro forma returns from an investment or a policy and assume that that's exactly what's going to happen. So there's a lot of, planning and stress testing that's going into this. But with all those things, and just for the record, he has actually done much, much better in all respects than what we modeled here. So he actually just retired this year in January at the age of 49. So good for him. But again, this is kind of just what we had planned at the beginning, and it's always nice to exceed the reasonable expectations that you have. That's one thing we always say, is to under promise and over deliver. But so in this column here, the total liquid, in the orange column, you see non IBC. So that is what he would be expected to have in total liquidity across his checking and savings accounts, the policy cash value, the investment returns, et cetera, if he didn't do the infinite banking concept. So on the other side, you see this green column, which is the total liquid using IBC. And in this case, he was originally planning to retire in 5 years. He actually moved that up by 2 years, which is pretty amazing. But again, with the assumptions we had a couple years ago when we put this together, because now you see here, the difference is he's got about $840,000 of total liquidity in year one using the policy. So you can see he is slightly behind, right? And those are those red numbers. He's got about $70,000 less in liquidity than he would have had, which is about 92%. And again, the reason for that is because in this example, that first year, the cost of the insurance is front loaded. He's putting in $300,000 and he has cash value of $230,000. So again, this is a long-term strategy. It's not a get rich quick scheme, but because he had such good cash flow and liquidity, he could easily absorb that slight decrease in liquidity in those first several years. And the way I explained it to him was, because he was working and doing really well, I said, you'll have less money when you don't need it and more money when you do need it, i.e. at retirement. So he's a little bit more behind in the second year, just because, again, those policy charges are kind of like starting. You got to capitalize your banking system to get this thing going. But at no point, even in this pretty conservative model, does he ever have less than 90% of the liquidity he otherwise would have had. And so, as you see, in these first couple of years, he's behind, and this is all cumulative, by the way. So this is in year one, he's got 911,000, over $1 million, and then these are all adding up. So, but then you see, starting in year 4, he's actually starting to catch up, right? He goes from being behind by about 88,000 to now he's only behind by 84,000. By the time he retires, he's about 71,000 behind of where he would have been, or 95% of that liquidity. And then he's catching up more and more. And then by the end of year 7, he's just about break even. And then here is where the infinite banking concept starts to come in and really shine. Now you can see, starting in the end of year 8, he's ahead of where he would have been otherwise, right? So he's got $40,000 more than he would have. Then he's got 97,000 more, so on and so forth. By year 16, which was the end of the anticipated, reinvestment profile of all those deals, once everything has gone full cycle, he is now about a little less than $800,000 ahead of where he would have been. So about 18% more liquidity than he would have had. So at this point, using IBC, he'd have about $5 million of total liquidity, and without using IBC, he'd have about 4.25. So he's now ahead by about $775,000 by year 16. And if I were to run this out to his expected lifespan of age 95, is what he told me to run it out to, you'd see this gets exponentially better over time, because the policy keeps increasing more and more, and he's never putting anything else into it. So this is just a graph of what it looks like. And you can see it's, in relative terms, just kind of zooming out at a big picture. Even though, yes, he's behind by about 70,000 to begin with, he's pretty close, all things considered, right? In relative terms, when you're talking about, millions of dollars, it's not that much difference. But you can see that line, that separation between the green IBC line and that orange non-IBC line starts to get bigger and bigger. And again, that separation between those lines in favor of IBC would become exponentially greater after 16 years. So that is kind of what sold him on this, is he's realized, okay, yeah, I'm going to be behind a little bit, but I can easily absorb that because I've got, again, we did a lot of good financial planning. I've got plenty of cash flow, plenty of liquidity. We stress tested things. I mean, if you were to see the actual spreadsheet that I put together for this whole thing, it's an absolute monster. In fact, we call it the beast. But again, beyond the scope of this conversation.
That's
so
awesome.
He's, just if we're looking at with no value whatsoever for the death benefit, the permanent, estate planning benefits and creditor protection, accelerated living benefits, all those extra things that come with the policy. If all we care about is the liquidity in terms of the cash value and how much he has in his bank accounts and everything across, his entire spectrum, that's a pretty compelling thing. And again, in real life, it's actually been significantly better, which is always good. But that's a big thing and why he realized that this was important. Now, especially for him, and again, this is not included in these numbers, the value of the tax benefits is enormous over time because he's getting money, a huge amount of money, into a tax-free account, again, assuming this is structured correctly as a non-MEC, which it is. And then he's getting a deduction on the interest that he'd be paying to offset the income that's coming from this investment. So you add that stuff up over time, especially if you're in a higher tax bracket. I mean, that is a huge benefit that I'm realizing as I'm starting to have to do a lot more tax planning these days, that's kind of my silver bullet for retirement planning and taxes, is getting as much into this, essentially it acts many ways like a non-qualified Roth account. So that's pretty compelling just by itself. Now, on the other side here, we have the total, what we call our inheritance, right? So that would be if he were to die, the amount of money between, again, this is not just the policy or even the investment. This is looking at his entire financial picture, which is, again, there's a lot more to this beyond the scope of this little sheet here. But because he only had $1 million of death benefit, and he's, they've got a net worth of like $6 million, $7 million. So he was pretty drastically underinsured. And that's never like the main value proposition that we're like selling for these policies, but it actually is important for his case. And so when we look at that, we compared, okay, for the insurance that you have and the inheritance that you'd have if you were to die and, all of your assets were sold, your liabilities were paid off, here's how much would go to your dependents, in his case, his 4 daughters and his wife. So without the IBC policy, he would have about $2.4 million of inheritance in that first year, just doing what he was doing before we started talking. In that very first year, because of the death benefit of the policy, he would have almost 7.7 million. So right off the bat, his inheritance is going to be $5.2 million more than it would have been. And then this is just the same exact thing that we're doing, like we talked about before with the liquidity. And you can see that advantage between IBC and non-IBC in the middle here continues to increase. Now, you'll see that it drops down a little bit after that. And the reason is because once we have the way we structure these, we put a term rider on it and some other things that is going to make that cost of insurance go down. So if you look over here, you see that his death benefit starts out at about a little under 7 million, climbs up to about almost $10 million by the end of that 10th year. And then it drops back down to 5 million. And that's because in this case, we assumed that he would do what's called a reduced paid up, or RPU, because he's no longer going to be paying any premiums into the policy. And while that does lower his death benefit, he still got a lot more than he would have. But what's important about that is by lowering that death benefit amount, that cost of insurance goes down drastically, and that's going to make the cash value growth that much more efficient. And since he was much more concerned about liquidity than death benefit, although he had some value for it, that was the kind of best way to structure this. So that's where you see in this comparison, that relative difference is not as much at certain points as it was. And then it starts to climb back up. And again, if I were to run this out over, you know, a 50-year time frame, that gap between the green and the orange line, again, it's pretty noticeable here, but it would be drastically more noticeable if we ran this out 40 or 50 years to his expected lifespan. So that's the quick and dirty of it. I know there's a lot there. We're going to go into another illustration using a business example, but we thought we'd just kind of do this in steps. Last week, we showed you, here's just a hypothetical policy illustration of somebody just to show, you know, what the numbers look like on the illustration itself. This one is a real life example of a client that I have who's doing this as an investor, doing these real estate deals and other syndications. And then what we're about to go into this coming week is going to be another real life case study with one of our co-agents here at Unbridled Wealth, who is really good at, he's a business consultant, and he's also, you know, a member of the team here, and he works with a lot of business owners, and he does company-owned life insurance. So we're going to give you another example similar to this, just showing what that looks like in a business context. So hopefully that makes sense. I know that's a lot, but we kind of wanted to just keep these short and sweet.
Yeah, I know it can probably feel like you're drinking from a fire hose, seeing all the numbers and hearing all of this information. That's why we encourage following up with questions and reaching out to us for a conversation that can be more specific to your finances. But one of the things that I think is so timely about this conversation is everything that's going on in our world surrounding banks, and what just happened with the Silicon Valley Bank last week. And I know that as this podcast sits on here over time, we'll see what continues to play out as far as that goes on the macroeconomic scale. But there is a significant amount of security that's added by building a strategy this way. And you can see it on the inheritance side. And so hopefully what we're doing in this conversation is adding value, as well as inviting you guys into continuing this conversation. So feel free to follow up with us and reach out, as well as stick around for the next episode, because we're going to keep getting into the numbers.
Yeah, we are. And Kyle, I just want to hit on that. You made such a good point there. And this is such a timely example of this. We talk about this a lot, the fractional reserve lending ratio, where banks can take $1 of deposits and lend that out 10 different ways. And that works great until you got a run on the bank or something like what just happened to. Now I think we're up to 3 or 4, maybe more major banks that could be potentially disruptive. And that's another huge benefit of the security of the strategy, is when you've got your money in a highly rated long-time mutual carrier that's conservative, they only have a 1-to-1 ratio. They can't take $1 and lend it out to more than, you know, one place. So you've got a lot more security in that structure. So that's another great point. We'll probably talk about that more in the coming weeks, but yeah, great addition there, Kyle. And again, this is a lot, but just go back, look at the other episodes, rewatch this one. We're trying to do this in layers, but we'll keep it short and sweet for this week, and we will see you on the next episode.